Hello sir, my name is Shubhadimar. In this project, I analyzed the financial performance of the Tata Motors from the years 2021 to 2025. I organized the raw data into this clean table for balance sheet and profit and loss statement to ensure accuracy. I have also used the sum formula for calculating the total subheads in balance sheet as well as in P&L. As well as in the P&L statement. In the column where the data was not provided, I have mentioned it as 0. All the values are in crore. Next, I have calculated the key financial ratios. I looked at the profitability, liquidity and solvency ratio. To ensure accuracy, I use the following standard formula. For gross profit margin, I have used the formula gross profit divided by revenue into 100. This shows the percentage of sales remaining after paying for the goods sold. For gross profit, I have used the formula revenue minus cost of material consumed. Next is net profit margin. The formula I used for net profit margin is net profit after tax divided by revenue into 100. This tells us how much profit is left from every rupee of sales after all expenses and taxes. Next, I calculated current ratio. The formula I used is I divided current assets by current liabilities. This measures an ability to pay off short-term debts. Next is quick ratio. I calculated the quick ratio by taking the total current asset and subtracting inventories, dividing it by current liabilities. This tells us if Tata Motors can pay its short-term debt using only its most liquid assets. Return on equity. Next is return on equity. I use the formula net profit divided by shareholders fund or equity. This is a key metric for investors as it shows how efficiently we are using their capital. Next is return on capital employed. The formula is EBIT, earning before interest and tax, divided by capital employed. The formula used for capital employed is total assets minus current liabilities. This is best measure of overall efficiency for a capital heavy business like Tata Motors. I compared these calculated ratios against the industry benchmark. For example, since our current ratio is 0.83, which is below the ideal benchmark of 1.50, I have flagged it as a red flag in my red flag dashboard with the help of use of conditional formatting. Even though the company successfully reduced its debt to equity ratio from 2.39 to 0.15, the low liquidity remains a constant red flag for cash flow risk. I also included a year-on-year change table to track growth and trends of the company over time. This table shows the percentage change in each ratio compared to the previous year, which helps identify if the company performance is accelerating or slowing down. For example, in 2024, we saw a massive 33.98% increase in net profit, which indicates a significant turnaround for the company during that period. By looking at these year-on-year trends, I was able to confirm that while revenue is growing steadily, the profitability is much more volatile. The formula I used for calculation of year-on-year change percentage is current year value minus previous year value upon previous year value into 100. Next, I will move to correlation analysis. I use the analysis tool pack I use the analysis tool pack to calculate the relationship between total revenue and net profit. As shown in this table, the correlation coefficient is 0.98. This is a near perfect match, proving that as Tata Motor increases its sale, its profit increases very consistently. This confirms that the company's turnaround is driven by its growing revenue. Next, I developed a regression model to predict future performance by using the data analysis tool pack feature. By using the data analysis tool pack feature in Excel, I generated this scatter plot and trend line equation which is y is equals to 0.221x minus 71732. This model predicts that for every additional rupee of revenue, approximately 22 paise contributes to the bottom line profit. For 2026, if the revenue reaches 4,90,532 crores, increases by 10% margin, the model predicts a net profit of rupees 36,675 crores. To validate the model, I use the analysis tool pack's regression tool to generate this summary output. My R square is 0.96, which means 96% of the profit changes are explained by revenue growth making. This is a very reliable model. The significance F is very low. 0.03, confirming that these results are statistically significant and not just due to random chance. I also created a red flag dashboard to track risks. While the company successfully reduced its high debt, the current ratio is still a red flag. We can see here that even if the company has reduced its high debt, the current ratio is still a red flag. It is red flag for all the 5 years. For 2021 to 2025, it's still red. It's below the benchmark, indicating a potential cash flow risk. Now, moving to my dashboard. This is my primary visual dashboard. I created these charts to provide a high-level view of the company's performance. You can see the trend line in net profit margin and gross profit margin over the 5 periods. I also included a liquidity ratio bar chart and a debt to equity to visualize and monitor on risk levels. Now let's move to the dashboard 2. On dashboard 2, I added interactive slicers to make the data more accessible. By clicking on specific year or category like profitability, the charts update instantly. This allows a manager to compare our performance against the industry benchmark. Which are indicated by this orange bar. For example, if I click on 2025 and I click on the solvency ratio, we got the exact ratios or for the 2025 and for the category solvency. To make the data manageable, I use this pivot table. It summarizes our complex financial figures into clear categories like gross profit margin and return on equity. This pivot table also changes when I change the dashboard. For example, currently the pivot table shows debt to equity ratio, but because I have selected solvency, if I go to profitability, the year remains same. Let's move to the pivot table and we will see that there are now all the profitability ratio which were earlier solvency but now has changed to profitability, as I have selected in dashboard to the profitability. So the dashboards and pivot table change side by side. To make the data manageable, I use this pivot table. Now let's move to the next dashboard data. This table is a bridge between my raw data and my visuals, allowing me to compare our sum of values against the industry benchmark efficiently. I also created this dedicated dashboard data tab to keep the backend of the project organized. This data I used in creation of pivot table. Here I have categorized every ratio by year and type, such as profitability, liquidity, and solvency. By structuring the data this way, the slicers on my dashboard can pull the exact numbers for any year, like 2025 or 2024, without any errors. It ensures that the dashboard remains dynamic and accurate as we switch between different analysis views. Now, let's move to my strategic insights tab. Looking at my strategic insights, I identified 3 key needs. Improve operational efficiency. Our operating margin is 0.09, which is 13% below the industry benchmark of 0.22. Optimize assets. The ROCE, return on capital employed, of 0.18 trails the industry standard of 0.20, suggesting we need better inventory turnover. Reviewing pricing and cost of goods sold. Our gross profit margin of 0.38 is currently lower than the 0.49 benchmark, indicating a need for better cost of sales management. To conclude, I have added the executive summary shows that while liquidity is stable, there are significant gaps in profitability and assets efficiency. My main recommendation is to initiate a cost audit to bridge the margin gaps and refocus capital on high return segments. Based on this 5-year analysis, the overall outlook remaining a hold until the efficiencies are met. Finally, I have compiled my entire analysis into this formal project report. I chose Tata Motors for this study because it provided a comprehensive 5-year dataset, that is from 2021 to 2025, allowing a deep longitudinal look at its financial health as a major player in the automotive sector. It presents a unique case study of how a firm balances high investor expectations against significant operational margin gaps. Next is the page of table of contents. Then next I have added the executive summary. In the executive summary, I have found a paradox. The company is very stable for long term and has a great return on equity, which is 18.96%, which investors love. However, it has a big problem with daily efficiency. Their operating margin is only 8.90%, while the rest of the industry is at 22%. This means they are spending too much on costs like rent and salaries. Then I have given introduction and project objectives, the purpose, the objectives, objective 1, objective 2, objective 3, and then 4. Then I have added the data processing and methodology of how I have done this analysis. We have calculated profitability ratio, liquidity and solvency, and market value also. I have done it in Microsoft Excel. Then formula that we have implemented. I have also added pivot table and conditional logic. Then benchmarking, I have also provided benchmarking. These benchmarks represent the gold standard for healthy company within this sector. I have also added the variance, the difference between the actual result and the benchmark. Then ratios and their profit gaps, gross profit margin and operating profit margin. Then why this margin is so low? Because the company is spending way too much on overhead or administrative costs. Then return on equity. In this, the company is doing a good job. Then my summary of finding. The company is selling products well, but as it is leaking money on the operational side. If we can bring the operating cost down to the match the industry, the company's total profit would be more than double. Liquidity and working capital review, the ability to pay bills, then the current ratio gap. The company's result is 0.83 but the industry mark is 1.50. Then we have done the quick ratio test, which is the asset test. The company's result is 0.68 but the industry benchmark is 1.00. This is a warning sign. It shows that if the company had to pay all its immediate bills tomorrow, it wouldn't have enough cash or receivables to hand to it. Then what this means for the business? This means under liquid, that paying suppliers late and having to take out expensive short-term loans. Then let's move to the solvency ratios. That means long-term financial stability. The company's result is 0.15 but the industry benchmark is 1.00. It is much lower than the benchmark. That means the company is being very careful with debt. This makes the company safe from going bankrupt in the long term and means banks would likely be happy to lend us money if we needed to expand. Then we have calculated the investors' confidence, the PE ratio, which states that the company result is 24.52, the industry benchmark is 1.00. The PE ratio is so high is very interesting. It tells us that even though the company has some cash flow and profit problems right now, the stock market is very optimistic. Investors are paying a premium because they expect the company to grow and fix its problem. Then my recommendations and final conclusion. To fix these issues, I recommend two main things in my report, that is, cut costs. They need to order their office administrative spending to stop leaking money. Manage cash better. They need to calculate payments from customer faster to fix their cash crunch. Then use loans wisely. Since they don't have much debt, they could take out a long-term loan to pay off stressful short-term bills. Then last final conclusion. Overall, Tata Motors have a very bright future, but it needs to be managed more efficiently because there are still some risk with their cash flow. My final recommendation is to hold. This concludes my analysis. Thank you for listening.